90% of people will never become truly wealthy. Not because they don't work hard enough, not because they don't earn enough, and not because they don't want it badly enough. It's because they unknowingly break the same 5 laws over and over again throughout their entire financial lives. And by the time they realize it, decades have passed. Today, I'm going to walk you through all 5, and I'll show you exactly how 2 people, same age, same starting point, end up in completely different financial positions 20 years later. Not because of luck, because of these laws. Subscribe if you find this useful. It genuinely helps the channel grow. Let's start with Law 1. Law 1. Time is the only ingredient that cannot be replaced. Here's a question almost nobody gets right. Who ends up wealthier? Someone who invests $500 a month for 10 years starting at 25 and then completely stops, or someone who invests $500 a month for 30 years starting at 35? Think about it. The first person contributes for only 10 years. The second person contributes for 30 years, 3 times as long, 3 times as much money out of pocket. The answer is the first person. By a significant margin, here's why. The person who started at 25 and stopped at 35 had their money in the market for 40 years total. The person who started at 35 had their money in the market for only 30 years. Those extra 10 years at the beginning, when the balance was small and the returns felt invisible, are actually the most valuable decade of the entire journey. Because of compound growth, the last decade of a 40-year investment career generates more wealth than the first 3 decades combined. The final years are where the snowball becomes an avalanche. Derek understood this intellectually. He just never acted on it. At 25, he told himself he'd start investing seriously at 30. At 30, he told himself he'd start at 35 once things settled down. At 35, he had a mortgage, 2 kids, and a lifestyle that consumed every dollar he earned. The delay cost him more than any bad investment ever could. Raymond started at 26. Not because he had more money than Derek, he had less, but he put $300 a month into a broad index fund and never stopped. He didn't try to time the market. He didn't wait for the perfect moment. He just started and let time do what time does. There's a mathematical tool called the Rule of 72. Divide 72 by your annual return rate, and you get the number of years it takes your money to double. At an 8% average return, your money doubles roughly every 9 years. In a 40-year career, that's potentially 4 doublings. Each doubling is larger than all the previous ones combined. Miss the first doubling by starting 10 years late, and you lose the largest doubling at the end. The one that would have made your final balance look completely different. Time cannot be borrowed. It cannot be bought. Every year you delay is a year of compounding permanently removed from your lifetime total. Law 1. Start now with whatever you have. Law 2. Equity makes you free. Income only keeps you alive. Most people spend their entire careers optimizing for income, chasing raises, promotions, better paying jobs, and income matters. But income alone has never made anyone truly wealthy, because income stops the moment you stop working. Equity is different. Equity is ownership, shares in companies, real estate, a business you built, and unlike income, equity doesn't stop when you do. It compounds while you sleep. It grows while you're on vacation. It works on weekends. Here's the gap that most people never see. Wages in the economy have grown at roughly 0.5% per year above inflation over the last several decades. Ownership, the stock market, real estate, businesses has grown at roughly 7% per year above inflation. If you put $1 into labor for 40 years, it becomes $1.22. If you put $1 into ownership for 40 years, it becomes nearly $15. That's not a small difference. That is the entire explanation for why some people build generational wealth and others retire on Social Security. Derek earned $180,000 a year, impressive income, but Derek spent $175,000 of it every year, a lifestyle that consumed almost everything he made. His equity was nearly zero. When Derek's income stopped, everything stopped with it. Raymond earned $70,000 a year. Every year, Raymond took a portion of his income and converted it into equity. Index funds, a rental property he bought modestly and held for 15 years. Reinvested dividends that compounded quietly in the background. Raymond's equity grew to a point where it generated more income than his salary ever did. The goal, the real goal, is to build equity large enough that its returns exceed your expenses. At that point, you are no longer dependent on a paycheck. You are free. A simple calculation. Take your annual expenses and multiply by 25. That is the equity target that makes you financially independent. If you spend $50,000 a year, you need $1.25 million in equity. At a 4% annual withdrawal, that equity sustains your lifestyle indefinitely. Most people never calculate this number. Most people have no idea what their target is, and you cannot hit a target you have never defined. Law 2, build equity. Convert income into ownership. Every month, without exception. Law 3, leverage multiplies everything in both directions. Leverage is borrowing to invest, using someone else's money to control a larger asset than you could afford alone. Used wisely, it can dramatically accelerate wealth building. Used recklessly, it can erase everything you've built in a matter of weeks. Here's a simple example. You buy a $300,000 property with $30,000 down, 10% of the purchase price. The bank provides the other $270,000. The property rises 10% in value. It's now worth $330,000. Your $30,000 investment just generated a $30,000 gain. That's a 100% return on your actual money. Not 10%, 100%. That is the power of leverage working in your favor. But now reverse it. The property falls 10% in value to $270,000. Your $30,000 equity has been completely wiped out. The bank still wants their $270,000. You now owe more than your stake is worth. Leverage amplified the loss just as powerfully as it amplified the gain. Derek used leverage aggressively. He borrowed to fund a lifestyle, credit cards, car loans, buy, now pay, later schemes. None of this borrowing went into assets that could grow. It went into things that depreciated, expired, or disappeared. Negative leverage. Borrowing to consume is the most expensive thing most people ever do. Raymond used leverage carefully and deliberately. He took a modest mortgage on a rental property. Leverage used to acquire an appreciating asset that generated monthly income. He never borrowed to fund consumption. The distinction sounds simple. For most people, it is the hardest discipline in personal finance. The rule with leverage is this: only borrow to acquire assets that generate returns higher than the cost of the loan. And always make sure you can survive a downturn without being forced to sell at the worst possible moment. Forced selling is how leverage destroys people, not the leverage itself, the inability to hold through a decline. Law 3, use leverage deliberately, only on appreciating assets and only what you can survive losing. Law 4, never blow up. Losses are not symmetric. This is the law most people understand least, and it is arguably the most important one. Losing 10% of your portfolio requires an 11% gain to get back to even. That sounds manageable. Losing 50% of your portfolio requires a 100% gain, a doubling to get back to even. That is years of recovery. Losing 90% of your portfolio requires a 900% gain to break even. For most people, that never happens. Losing everything 100% requires infinite recovery. The game is over. The math of losses is asymmetric. The deeper the hole, the harder it is to climb out. And the longer you spend climbing back to where you started, the less time your money has to actually grow. This is why surviving, staying in the game, is more important than maximizing any individual return. A consistent 8% over 40 years beats a spectacular 30%, followed by a catastrophic minus 60% every single time. Derek went all in on a concentrated stock position he was convinced would triple. It fell 80%. He spent 4 years recovering money he had taken a decade to build. During those 4 years, Raymond's boring, diversified portfolio quietly compounded. Raymond's rule was simple. Never put yourself in a position where a single loss can permanently damage your financial future. No single investment, no single bet, no single moment of conviction that overrides the discipline of diversification. Protect the downside first. The upside takes care of itself. Law 4, never blow up. Survival is the prerequisite for everything else. Law 5, diversify where you have no edge. Concentrate only where you do. Most people have no genuine informational edge over professional investors in picking individual stocks. The data is sobering. Roughly 67% of individual stocks underperform the broader market over long periods. Only about 4% of all publicly traded stocks are responsible for essentially all of the market's total wealth creation. The odds of correctly identifying those 4% in advance are extremely low. Even professional fund managers, with teams of analysts and access to data most individuals never see, fail to beat a simple index fund the majority of the time over a 20-year period. This is not a reason to be pessimistic. It is a reason to be strategic. If you have no particular edge in a market, and most people don't, the rational move is to own the entire market through a low-cost index fund. You capture all the gains from that winning 4% because you own all of them. You don't need to predict which ones will win, but there is an exception. If you have genuine knowledge, expertise, or control in a specific area, your own business, your own industry, a specific asset class you understand deeply, concentration in that area can be justified. A business owner who understands their market better than anyone can rationally concentrate their wealth in their own company. The key word is edge, not conviction, not enthusiasm, not a tip from a colleague, genuine informational or operational advantage. Derek spent years picking individual stocks based on gut feeling and financial news. He underperformed a basic index fund by a significant margin almost every year. The fees, the taxes from frequent trading, and the poor timing of his entries and exits quietly eroded his returns. Raymond owned index funds. He never tried to pick winners. He never watched financial news looking for hot tips. He owned a small piece of everything and let the economy's long-term growth do the work. Boring, effective, consistently ahead of the majority of active investors. Law 5. Diversify by default. Concentrate only where you have a genuine, demonstrable edge. 5 laws. That's the entire system. Law 1. Start early. Time cannot be replaced. Law 2. Build equity. Convert income into ownership. Law 3. Use leverage carefully. Only on appreciating assets. Only what you can survive. Law 4. Never blow up. Survival is the prerequisite for everything. Law 5. Diversify by default. Concentrate only where you have a real edge. Raymond followed all 5, imperfectly, inconsistently at times, but directionally correct for 20 years. Derek broke all 5, not out of stupidity, but out of the same instincts most people have. Spend what you earn. Wait for the right moment. Chase the big return. Take the big bet. Pick the winner. Those instincts feel natural. They are financially catastrophic. The 90% who never build real wealth aren't unlucky. They're just following their instincts instead of these 5 laws. Now, you know the laws. The question is what you do next. Subscribe for more videos that give you the financial clarity most people never find. I'll see you in the next one.